Welcome to The Explainer. You've probably heard about it, this incredible growth happening with private companies, a world that's been pretty much off limits to everyday folks. Well, now there's this new product, the Private Equity ETF, and it's promising to hand you the key to that exclusive club. Today we're going to find out, does that key actually work?
All right, so let's get right into it. Why is everyone so hyped about this? Well, you've got to understand the massive shift that's been happening in the market. I mean, look at this. The number of companies you can actually buy on the stock market, it's been chopped in half since the 90s. But at the same time, the private market, it's just exploded. We're talking a five-fold increase to nearly $6 trillion. So a huge chunk of the economy is basically moving behind this wall that most of us just can't see over.
And you know, this really gets to the heart of the problem. Think about it. So many of today's most exciting companies, the ones really driving innovation, the next potential game changers, they're staying private for way longer. And all that incredible growth they experience, it's happening before they ever go public. That means regular investors, people like you and me, are missing out on a massive piece of the action.
Okay, so you've got this problem, right? So, naturally, Wall Street comes up with the solution. They've cooked up this brand new product aimed squarely at the everyday investor, the Private Equity ETF. And the promise? It's so simple, so appealing. We're going to finally tear down those walls for you.
And man, is it a compelling promise. I mean, traditionally, if you wanted a piece of a private equity fund, you better have $1 million lying around and probably a lot more. But with these new ETFs, you can jump in for what, maybe $27 a share? The price of a decent lunch? The appeal is just so obvious, right? It feels like that velvet rope at the exclusive club is finally being lifted for everyone.
This quote here from John Blank really nails the sales pitch. You hear this word a lot, democratize. The idea is that we're finally giving everyone a shot, a chance to get exposure to this super exclusive asset class, and you can do it right from your normal brokerage account. But here's the question we have to ask. Is getting exposure the same thing as getting the real deal?
And that brings us to, honestly, the most important question of all. When you buy one of these things, what are you actually buying? Let's pop the hood on these funds and see what's really going on.
Okay, this is where it gets really interesting. There's this little SEC rule that most people don't know about. And it basically says that these funds, they can only hold a maximum of 15% of their money in actual private companies. The illiquid stuff that's hard to trade. So right from the get-go, a whopping 85% of your investment has to go somewhere else.
So where is that somewhere else? Well, a lot of the time, it's just giant, publicly traded tech stocks. We're talking Nvidia, Oracle, Meta, or they'll buy shares in the publicly traded private equity firms themselves, like Blackstone and KKR. In other words, they're mostly filled with stocks you could just go out and buy yourself any day of the week without paying for this fancy private equity label. And that really is the core of the criticism from people who live and breathe this stuff. Nina Mishra here, the director of ETF research, she puts it so plainly. These are not real private equity investments. You're not getting access to that exclusive deal-making. You're just buying a bundle of public stocks that sort of, mimics the private market.
All right, let's talk numbers, because this is where the picture gets crystal clear. We're looking at fees versus performance. I mean, if you're buying a product that maybe isn't exactly what it says on the tin, you'd at least hope the returns are amazing, right?
First up, let's talk about cost. And wow, this is a biggie. Some of these so-called private equity ETFs are charging fees of almost 3% a year. Now, to put that into perspective, you can buy a simple gold ETF for something like 0.1%. That is a massive premium you're paying just for this supposed access.
Okay, so you're paying these super high fees. Are you at least getting incredible returns? Well, the data over the last decade is kind of brutal. A simple, boring S&P 500 index fund gave you over 15% a year. And these fancy private equity ETFs, one gave you 8.7%, the other just 6.8%. They didn't just underperform, they got absolutely trounced by the regular old stock market.
So let's just break that down. The takeaway is pretty simple and pretty stark. You're paying a lot more to get a lot less. That is a really, really tough equation to make sense of.
And it doesn't stop there. There's another risk we got to talk about, and that's transparency, or maybe the lack of it. Let's take an example, right? An ETF holds SpaceX, a private company. Now, let's say some huge news drops that could totally change its value. Well, the price of that ETF you own,
it might not change to reflect that news for days or even weeks. On top of that, you often have no idea what other hidden fees are being charged just to hold these private assets. It's kind of a black box.
Which brings us all the way back to where we started, the final takeaway. Is this real access, or is it just an illusion?
You know, when you stack it all up, the crazy high fees, the really poor performance, this whole lack of transparency thing, it's no surprise that experts are, well, they're deeply skeptical. The argument from people like Nina Mishra is pretty clear. Most investors are probably way better off just sticking with a simple, low-cost index fund that's actually got a solid track record.
And really, if there's one thing to take away from all this, it's this. Access is not the same as equivalence. Just because you can buy a product that has private equity stamped on the label doesn't mean you're getting the same benefits as a real private equity investment. And confusing those two things, well, that can be a really, really expensive mistake.
So look, these ETFs offer this really tantalizing peek behind the curtain, a glimpse into a world that used to be totally locked down. But when you look at the data, it suggests the price of that ticket might be far too high. Which leaves us with that final question you see here. Is the promise of access worth the price of admission?